Okay, non-taxable exchanges. So here's our lecture overview. And the title of this chapter is non-taxable exchanges. So we always want to make sure that we're on the same page in terms of vocabulary. And so when we're talking about exchanges, we're just talking about buying and selling. And that's not always with money. Sometimes property can be given as part of the buying price. Sometimes can be given as part of the buying price, and sometimes debt can be assumed as part of the buying price. Now, the exciting thing about this chapter is not the word exchanges, but the word non-taxable. So what that means is that some gains and losses on some property is tax deferred, or even better, gains and losses on some property is tax free. So this is obviously information that will be very valuable to clients. So the first thing we're going to talk about is like-kind exchanges, and here's just an introduction to it. Now, like-kind exchanges are governed under Section 1031, and this is one of those section numbers that you probably need to know the section number, because you just hear like-kind exchanges referred to as Section 1031 exchanges really frequently. So both like-kind exchanges and 1031 exchanges, same thing. Okay, so obviously we haven't talked about these yet. So with no like-kind exchange, gains are recognized when they're realized. So this is the case that we've had so far. Heather bought rental property for $150,000. She sold her rental property for $200,000 at a gain of $50,000 in year one, and she will include the $50,000 of her gain in the taxable income in year one. She soon bought another rental property for $200,000, sold it 4 years later for $250,000, and so she will include another $50,000 of gain in her taxable income in year five. So she's realized a total of $100,000 of gain, and she recognized the $50,000 in each year that she actually sold the respective property. Now, with a like-kind exchange, however, gains and losses can be deferred or postponed in terms of recognition. So, for example, Shirley had a gain with a like-kind exchange in year one. That gain will be deferred, meaning it will not be recognized in year one, so she won't be paying taxes on it in year one. Now, it will be recognized at a later date because these gains and losses are only deferred. Okay, example, Mitchell had a loss with a like-kind exchange in year one. That loss will be deferred, meaning it will not be recognized in year one, but at a later date it will be recognized. So what exactly is a like-kind exchange? It's a purchase and sale of realty used in a trade or business or for the production of income. And so we've had this word realty before, so think land and buildings. Now, it's a purchase and sale of realty. So you can sell land and buy an office building. You can sell an apartment building and buy land. You can sell an apartment building and buy a rental property. So as long as you are purchasing and selling realty used in a trade or business or for the production of income, it has a potential to be a like-kind exchange. Now, when we use the word exchange, we don't mean that the buyer and seller have to actually exchange with each other. So, for example, the seller can sell to person A and buy the replacement property from person B. So, the client here will sell realty and buy realty, but doesn't have to necessarily be, to sell to the same person and buy from the same person. Now, here are the requirements for a like-kind exchange. A purchase and sale of realty used in a trade or business or for the production of income. The proceeds from the sale must go to an escrow agent, not to the seller. So the seller cannot touch those proceeds, can't put them in his own bank account and then put them in an escrow account. They have to go directly to escrow. The replacement property, the property that will be bought, must be identified within 45 days before or after the sale of the realty. So you can't mess around and think, one of these days I'm going to find my replacement property. You got to really have it in mind pretty close to the selling date of the first property that you sell. And the closing of the purchase of the replacement property must take place by the earlier of 180 days from the sale of the original property, or the due date, including extension of the tax return for the year the original property was sold. So, so there you go. And the property must be U.S. for U.S. property or foreign to foreign property. Exchanging U.S. for foreign property or foreign property for U.S. property will disqualify you from having a like-kind exchange. So here's an example. Liz has an apartment building. Now she would prefer to own an office building at this time. So now both properties are or will be U.S. Realty. She sells the apartment building to person A on June 1st of year 1. The sales proceeds are deposited directly into an escrow account. The replacement property, office building, is identified on May 15th of year 1, which is within 45 days before the sale of the apartments. Now, it also could be identified within 45 days after the sale of the apartment building. So you've got a 90-day window there surrounding the sale of her, in this case, her apartment building. Now, the purchase of the office building from person B is completed and the sale is closed on November 3rd of year 1, which is within 180 days of the sale of the apartment building. Now, note the deadline for the purchase of the office building is the earlier of 180 days from the sale or the due date of the tax return for the year, which would be April 15th x2. So in this case, the 180 days is sooner than the due date of the tax return. So that was her deadline, 180 days. Now, this exchange qualifies as a like-kind exchange. If the apartment was sold at a loss, the loss would be deferred. If the apartment was sold as a gain, all or some of the gain will be deferred. So I've deliberately left off numbers here at this point. Now, like-kind exchange treatment is mandatory if the exchange qualifies. So if you don't want a like-kind exchange, you must set up the exchange. If you don't want one, make sure that you don't qualify. If you do want a like-kind exchange, be sure you set up the exchange as a qualifying exchange. So it's easy to blow it if you want one. And if you don't want one, make sure that you don't qualify. You can postpone the identification of the property, the closing on the property, or you can not deposit the sale proceeds directly into an escrow account or something. So here is a very important vocabulary word, boot. So boot to us means anything given or received in exchange other than the property itself. For example, cash is considered boot in a like-kind exchange, assuming debt is boot in a like-kind exchange. Okay, so now we're going to add some numbers to this analysis, and you have a handout that gives you the steps for analyzing like-kind exchanges. So you might want to follow along with that handout as we do this. But our first example is we're going to have a like-kind exchange at a gain, and we're trading up. So again, let's make sure we're on the same page in terms of vocabulary. So when we say at a gain, what we mean is the property sold has a fair market value greater than the adjusted basis. And so if the property was just sold outright instead of doing an exchange, there would be a gain. So look down here before the exchange, this person has property with fair market value of $450,000, adjusted basis of $130,000, so there's potential gain of $320,000. Okay, so now we know what we mean when we're saying we have a like-kind exchange with a gain situation. Trading up, what does that mean? Trading up means that the property bought is worth more than the property sold. So after the exchange, this person has property with a fair market value of $600,000, which of course is more than the property that was sold. Okay, so let's do our numbers. Keegan swapped rental property shown below for property worth $600,000. So the property shown below, you have fair market value of $450,000, adjusted basis of $130,000, potential gain of $320,000. Now he gave up the rental property worth $450,000 and paid $150 cash for the new property. So the new property has fair market value of $600,000, and that's what he paid for it. But partly it was with property and partly it was with cash. Okay, so step 1, fill out the chart as shown below. So anytime you have a problem, and here in this course, and also more or less in real life, you're going to know this initial information probably pretty early in the whole process. So you've got all of these numbers already. Okay, now step 2, you're going to have to calculate the adjusted basis and potential gain of the new property. So how do you calculate the adjusted basis? You take this original basis, which we call a carryover basis, of $130,000, and we're going to add any boot given by Keegan. So boot, again, is anything other than the property. So here he gave $150,000 cash. And so the new basis will be the carryover basis plus the $150,000 or $280,000. So now we can fill out the adjusted basis after the exchange. And as you can see, the potential gain here, voila, it's the same. It's $320,000. So step 3, what you're going to do in your analysis next is you're going to compare the two potential gains. And of course, in this particular instance, the two potential gains are the same, so no gain is recognized. Okay, good. Now, the gain recognition, of course, is only deferred, as we said. And so when the new property is sold, the gain will be recognized. And so assume that the second property is later sold for $700,000. The recognized gain at that time is the $700,000 minus the adjusted basis, so $420,000. So we have a deferred gain. Okay, so here's just a practice problem. So go ahead and do this. Want to exchange property with a fair market value of $800,000, adjusted basis $500,000, plus $200,000 cash for $1 million property. Complete the chart below. What is the gain recognized in the year of the exchange? Okay, so step 1, of course, you fill out this initial chart, then you figure out the adjusted basis, and the adjusted basis is a carryover basis plus boot given. So the $500,000 plus $200,000, and so then you calculate the potential gain, and since they are the same, there will be no gain recognized in the year of the exchange. Okay, now is this a good thing? We've deferred gain. So the like-kind exchange at a gain trading up, here's a summary. If you exchange gain property and you trade up, all the gain's going to be deferred. Now, is this a good thing or a bad thing? We're going to leave that. I'm going to leave you in suspense. Okay, now we're going to have an example of a like-kind exchange at a gain trading down. So this is Juan doing this. So Juan swapped rental property shown below for property worth $350,000. So we have the same numbers before the exchange that we had in the last example. He gave up the rental property worth the $450,000 and received new property and $100,000 cash. Now the new property is worth $350,000, and so this person exchanged with him by giving him $350,000 and $100,000 cash. So Juan received the fair market value of the property that he sold. Okay, so the next step, of course, is to find the adjusted basis. And so calculate the adjusted basis of potential gain of the new property. So again, take the original basis, the carryover basis of $130,000, and you're going to subtract any boot received in excess of the original potential gain. Now, how much boot did he receive? $100,000 of cash. The original potential gain was $320,000, so he did not receive boot in excess of that original potential gain, and so we just have the carryover basis. And so we have a new adjusted basis in the new property of $130,000, and the potential gain is only $220,000. Okay, step 3. Of course, is we're going to compare the two potential gains. And of course, here we see that the potential gain has decreased. And so, the potential gain has decreased by $100,000. Recognize the decrease to the extent of boot received. So boot received $100,000, and so you're going to go ahead and recognize the whole $100,000 in the year of the exchange. Okay, another example of like-kind exchange at a gain, trading down with Anna. So Anna swapped rental property shown below for property worth $100,000, so she traded way down. Okay, she gave up the rental property worth $450,000 and received the new property and $350,000 of cash. Okay, so fill out the chart below. Calculate the adjusted basis of potential gain of the new property. So again, same process. Take the original basis, the carryover basis of $130,000, subtract any boot received in excess of the original potential gain. She received boot of $350,000. The original potential gain was only $320,000. So we have an excess of $30,000. And so we will reduce the adjusted basis in this case by that $30,000. And so we have a new adjusted basis after the exchange of $100,000. And you can see here now after the exchange, potential gain is only, well, not only, it just is zero. There's none. So, as we know, now we're going to compare the two potential gains. It has decreased by $320,000. And so you're going to recognize gain to the extent of boot received. So the boot received here, the potential gain decreased by $320,000. Recognize that decrease to the extent of boot received. And so you receive 350 boot. Recognized gain is 320. So the most gain you're going to recognize is that decrease in the potential gain. Here's a practice. Barry exchanged property with a fair market value of $800,000, adjusted basis of $500,000 for property worth $200,000 plus $600,000 cash. So complete the chart. What is the recognized gain in the year of the exchange? So go ahead and work this out. And so your adjusted basis has gone from $500,000 to $200,000. Why? He received $600,000 of boot. The original potential gain was $300,000. And so the boot received that was in excess of that potential gain is $300,000. So you're going to reduce the original adjusted basis by that boot in excess of the original potential gain. So this gets you down to an adjusted basis of $200,000. Again, you can see the potential gain went from $300,000 to zero. And so you're going to recognize that decrease in the potential gain as long as you received that much boot, which of course you would, so and more. And so your recognized gain here will be $300,000. Here's another practice. So go ahead and do this, please. Okay, so here we have Harry exchanged property with a fair market value of $800,000, adjusted basis of $500,000, for property worth $700,000 plus $100,000 of cash. And so the adjusted basis here is $500,000 for both the new and the old. You have a carryover basis after the exchange because you only reduce that basis if the boot to the extent that the boot received is greater than the original potential gain. You only got $100,000 of boot. The original potential gain was $300,000, so the adjusted basis stays the same. Your potential gain falls by $100,000, and so you will recognize gain in this case of $100,000. So, like-kind exchanges at a gain, trading down summary. Exchanging gain property and trading down results in at least some gain recognition. The more you trade down, the more gain will be recognized. And be aware that this gain is subject to that net investment income tax if that taxpayer is over that modified adjusted gross income threshold. So if you don't remember how to calculate that NIIT, go back and review that. And as you saw, if you trade down enough, you recognize all the gain, and so the 1031 exchange really hasn't had any effect on you. You might as well not have done one. Okay, liability relief or liability assumption is also a form of boot. So assuming debt is boot paid, which means that the buyer takes over the mortgage payments. Getting debt relief is boot received, which means the seller no longer has to pay the mortgage. Okay, here is an example from the book, and I think it's a good exercise to think this through. Riley and Ryan exchange real estate. Riley and Ryan engage in a like-kind exchange. Riley transfers real estate with a fair market value of $400,000 and an adjusted basis of $250,000 to Ryan. He receives Ryan's property with a fair market value of $500,000. Riley also assumes Ryan's mortgage, $100,000, and this is $100,000 of boot received. Ryan transfers real estate worth $500,000 and an adjusted basis of $200,000 to Riley. He receives a property with a fair market value of $400,000. He also receives boot of $100,000 because Riley will repay the remaining mortgage. So I think this is kind of confusing to read it, but pause and see if you can work through this because it's a good exercise. Okay. So let's look at Riley first. Before the exchange, he had fair market value of $400,000, basis of $250,000, potential gain of $150,000. After the exchange, the fair market value of the property he had then was $500,000. Now his new basis went up by $100,000. Why? Because he assumed Ryan's mortgage. So it's like he gave an additional $100,000 of cash. He now has $100,000 more debt than he used to. And so the basis went up. The potential gain is the same. And so, as you know, if the potential gain is the same, there will be no gain recognized. Now, Ryan had fair market value of $500,000, basis $200,000, potential gain originally of $300,000. He traded down. So after the exchange, the fair market value of the property is $400,000. Now, he has a carryover basis. Why? Ryan did receive boot because he no longer has to pay the mortgage, but the boot was not greater than the potential gain. And so you have the same carryover basis. Notice that the potential gain went down by $100,000, and so Ryan will have to recognize gain of $100,000 in the year of the exchange. Okay, let's talk about like-kind exchanges at a loss. Dylan swapped rental property shown below for property worth $600,000. So you can see his original property is lost property. The market's gone down. The property's only worth $120,000. The adjusted basis is $130,000. So he gave up the rental property worth $120,000 and received new property worth $100,000 plus $20,000 of boot. So step 1. Fill out the chart as shown below with the information that you already have. Okay, step 2, calculate the adjusted basis and the potential gain or loss of the new property. So take the original basis, the carryover basis of $130,000, and you will subtract any boot received. Okay. Notice here there's no comparison of the original potential loss. Is it greater or less than the potential loss or anything? You're just going to subtract any boot received. Here, Dylan received $20,000 cash, so you can see that the adjusted basis went down by $20,000. Now, the potential losses are the same. So the new basis is $110,000. So, step 3, compare the two potential losses. As you can see, they're the same. The two potential losses are the same, so no loss is recognized. And I don't want to keep you in suspense, so I'm going to tell you that when you have a like-kind exchange and a loss, you will never recognize the loss. So you will always come up with the same potential loss. So Doug exchanged property with a fair market value of $800,000, adjusted basis of $900,000 for property worth $1 million. He assumed the remaining mortgage of $200,000. Complete the chart below. What is the loss recognized in the year of exchange? So this is practice, so go ahead. Fill it out. Okay, so the adjusted basis of the new property has gone up by $200,000. Why? Because he he assumed the remaining mortgage of $200,000. So it's just like he paid an additional $200,000 of cash. So again, your potential losses on these lost properties are always going to be the same, and no loss will be recognized. Summary, if you have a like-kind exchange at a loss, exchanging lost property results in a deferral of loss. So again, I'm going to leave you in suspense. Is this a good thing or a bad thing for the client? Okay, now we will find out. Okay, reduce gross income. Use a like-kind exchange on gain property if you desire to defer a gain. Now, deferring a gain is kind of this typical situation because what you're doing is you're, not including extra income this year, and so you are postponing taxes this year, which is usually a good principle. But control the timing of gross income. Make sure an exchange of gain property is not structured as a like-kind exchange if you do not wish to defer income taxes. So there are circumstances in which you don't wish to defer income taxes. Why? Because sometimes taking gains may be useful to offset losses. For example, if a property exchange results in gains, the gains may be used to offset capital losses. Because remember, capital losses can only be used to offset capital gains, and net capital losses are limited to $3,000. Control the timing of gross income. Jane has some large capital losses from the sale of a business. She is also exchanging gain property eligible for Section 1031 treatment. She should not do a Section 1031 exchange. She should take the gains and use them to offset those capital losses in her portfolio. Also, avoid additional taxes, interest, and penalties. So recognized gains are subject to the net investment income tax. So if it's possible, and sometimes you have situations where it's possible, control the timing of a gain recognition to avoid or reduce the NIIT. Harold and Maude have business income in year one of $250,000. The NIIT threshold for married filing joint. So income is expected to be down in year two. So they'll be under that threshold for the NIIT. They have a Section 1031 exchange that will result in some gain recognition. So if possible, postpone the sale of the property until year two to reduce or avoid the NIIT. So sometimes you'll have situations where the year of exchange is flexible. Also, make sure an exchange of gain property is not structured as a like-kind exchange if you do not wish to defer income taxes. Here's another situation. If tax rates are expected to increase in the near future, it may be wise to take the gain and pay taxes at a lower rate today. And we have a lot of talk of increasing taxes in the future, so this could be relevant. You always have to watch and see what's happening. Control the timing of gross income. When exchanging lost property, avoid structuring the exchange as a like-kind exchange if there are offsetting gains that could be reduced by the loss. So sometimes you want those losses to offset gains. When exchanging lost property, structure the exchange as a like-kind exchange if tax rates are expected to rise, or if the client's tax bracket is expected to increase. So sometimes taking losses in the future rather than currently can reduce tax more in the future, and sometimes it's worth it then to postpone taking the losses.